What is up, fam? It's Peyton here, and today we are going over chapter 2 of One Up on Wall Street. It's one of my favorites, where he talks about the red tape of Wall Street and how you are at an advantage as the independent/retail investor due to not having the same cultural, legal, and social barriers institutions have. I'll be throwing the word institutions around a lot, so what I mean by that is mutual funds, analysts, hedge funds, quote unquote, that big money that manages multi-millions to multi-billions of dollars. So with that out of the way, let's talk about his first point. Demographics. Also, the people making decisions are usually middle-aged white men. No offense. It completely cuts out the geniuses on each side of the age and race spectrum that have certain life experiences or fields of thought about businesses that might be successful. Example here, Mercado Libre, a Latin America version of Amazon. I'm going to tell you right now, the first people that knew about this or used this was not a middle-aged white man working at a hedge fund on Wall Street. It was people in Latin America and the Latino community. Next up is street lag. Under the current system, a stock isn't truly attractive until a number of large institutions have recognized its legitimacy, and an equal number of respected Wall Street analysts have put it on the recommended list. It's like that empty dance floor, and that song is straight fire, but nobody wants to be the one that makes the first move. You gonna do it? You gonna do it? I'll do it. Just because a few analysts don't cover a stock does not mean it's a bad stock. Dig a little deeper and see if it has potential to be huge. Next up was the investor trying to keep their job. There was a saying back in the day, you'll never lose your job losing your client's money in IBM. To update this a little bit, you will never lose your job investing in Apple. If Apple goes bad, it's not on the investor, it is on Apple. The bosses will say, what's wrong with Apple? Why didn't they hit their marks? And they won't usually point the finger at the investor. But if you're invested in Tesla 5 years ago, man, you were a psycho. Who's laughing now though? Next up is the pre-approved list. This is sad. Bank pension fund departments and insurance companies invest in a pre-approved list due to self-protection from that quote unquote diverse performance. What is diverse performance? Let's explain. Imagine if there were two people that were on the golf course discussing about their pension accounts. And in this example, both of them have their pension accounts with JP Morgan. One of them have a 20% return on the year and the other had a 40% return on the year. Not bad, right? Wrong. The one with the 20% return is calling JP Morgan right now and saying, why don't I have a 40% return on my stock portfolio? To keep this from happening, they give all the pension managers, the ones moving the money around, a pre-approved list of stocks to pick from. That way, it's very likely that both Smith and Jones in the example will enjoy the same result, or at least the difference will not be great enough to make either of them mad. Next up is the customer. Because institutions are investing in other people's money, other people have a say. Let's do an example because it's easier to understand this way. Let's say Randy is a great investor and he's picking stocks that are great for growth and is managing the pension for a company. That company has a certain individual, let's call him Richard, and he's bothering Randy every 3 months and grading him on his stock picks. People like Richard think they're God's gift to earth and tells Randy how to do his job. Instead of dealing with Richard and other people like him, Randy just sticks to safe stocks that won't raise an eye. Apple, Microsoft, Coca-Cola, you get my point. The returns are not going to be as good. Lastly is legal restrictions. The SEC, US Securities and Exchange Commission, have certain rules in which institutions have to follow. For example, a mutual fund cannot own more than 10% of shares in any given company, nor can mutual funds invest more than 5% of the fund assets in any given stock. It'd be like you owning $100 and you can only invest $5 into Apple. That sucks. It keeps funds from putting all of their eggs in one basket, even if that basket is good. The bigger funds can only invest in the top 90 to 100 companies out of the 3,500 that are publicly traded. And some funds are restricted within market cap, which defined simply is the current market price times all of the shares that are available, outstanding shares. So if the market cap of the stock is less than 100 million, they can't own the stock. So a lot of times the SEC have restricted institutions to the point where they can't invest in small companies that can grow at a rapid rate, but you can. In conclusion, you can find terrific opportunities in the neighborhood, workplace, Discord chat, YouTube videos, and websites years before the news reach the analysts and the fund managers they advise. You're not at a disadvantage, quite the opposite. While everyone is strapped in with rules and regulations, either by the company or the SEC, you are free to invest in anything you want. So build convictions by doing quantitative and qualitative research on companies you believe in and go get them. As always, I love you and I believe in you. Peace.